My nose. This is really embarrassing. I'm so sorry. Please forgive me. Okay, let's look at financial needs and planning and implementing. I always ignored this when I was doing year 12. When I was doing year 12, when I was in business, when I was studying business in year 12. I don't know if you guys are the same, but when I was doing business, like when I thought of processes, I was like ratios. I was like, I need to do the ratios. I literally forgot that any other point existed. I was like, it's just the ratios. No, it's not. No, it's not. And then I'd get questions on this and I'd be like, I don't actually know anything. So I still sometimes forget that this comes up in processes because I feel like there's such a focus on the ratios, but this is how they can trick you. So the financial needs of a business are determined by the size of the business, the phase that it's in, the future plans for growth and development, and the capacity to source finance. So depending on that business plan, financial management has to set out the finance required, how they're going to source that, and then display their range of financial statements. But that financial statements also need to show that the business can generate a return on the investment. That's why they then use budgets, which provide information in quantitative terms about requirements to achieve a particular purpose. Budgets can show the cash required for planned expenditure, the cost of capital expenditure, the estimated use and cost of raw materials or inventory, and the number and cost of labor hours required for production. The budgets are just kind of showing all that planned expenditure, and then they can then use that for planning and implementing cuts and then applying strategies from there. Budgets also provide financial information on a business's specific goals and are used in operational, tactical, and strategic planning. Like we said, operational is day-to-day goals, tactical is 1 to 2 year goals, and strategic planning is 5+ year planning. They enable a constant monitoring of objectives and provide a basis for administrative control of expenses, and production planning. They also allow for the comparison of planned performance against actual performance to determine whether corrective action needs to be taken. So, then we get into record systems, which are the mechanisms employed by a business to ensure that data is recorded and the information provided is accurate, reliable, efficient, and accessible. A critical process in maintaining record systems is to minimize the amount of errors in the recording process to ensure financial managers produce accurate and reliable financial statements. I feel like record systems, the most important thing is kind of this point where it's like, let's minimize the amount of errors so that our reports are as accurate and reliable as possible. And to do that, they can use the double entry system of accounting, which acts as an important control mechanism, and it balances the entries and finds errors between them, just so you're not admitting systems that and accounting statements that have errors in them. But in that, financial risk comes. So financial risks are the risk to the business being unable to cover its financial obligations. So if the businesses aren't able to meet their financial obligations, they face the possibility of becoming bankrupt or insolvent. And then that's an added risk for businesses if they finance the operation from external debt instruments, because then they're getting chased up on all that money externally. So to minimize financial risk, businesses must consider the amount of profit that needs to be generated and then make sure that they're covering the cost of that debt as well as making a profit. It's great to make a profit, but if that profit and all it's doing is covering you the cost of your debt, you're literally at zero. It's like covering that debt and then still making profit on top of that. Then comes financial controls, which are the policies and procedures that ensure that the plans of a business will be achieved in the most efficient way. The most common causes of financial problems are theft and fraud, damage or loss of assets, and errors in the recording system. But that's why it's so important to have monitoring and financial controls in place so that you can monitor your assets like accounts receivables, inventory, and cash. The policies to do that and to promote control are clear authorization and responsibility for tasks in the business, separation of duties, rotation of duties, and control of cash. So important. Control of cash can literally be done with a cash register, but separation of duties and rotation of duties along with clear responsibility for tasks is really, really important. If you've got one person in a business who deals with all the accounts receivables, signs them all off, counts all the cash at the end of the day, banks all that cash, is doing all the record systems. If you've got one person doing all of those duties, you're more at risk to issues like theft and fraud because it's a lot of trust in one person. While if you're doing a separation of duties and a rotation of duties, and each of those duties have clear authorization and responsibility, you're more secure and stable because more people are going through it, which means naturally there's more checking and naturally you can pinpoint where it is that any of these common financial problems may begin. Now, debt financing relates to short and long-term borrowing from external sources. The disadvantages of that, and this comes in, debt financing is also in influences, so that's why I wanted to talk about this point. Um, the advantages of debt financing are that funds are readily available and can be acquired at short notice. The interest repayments are tax deductible as well, and it doesn't dilute the current ownership of the business. So if I go to a bank and I'm like, hey, I need a loan, I'm not losing control of my business. But if I was to turn to equity financing and I opened up shares for my business, I dilute the control that I own. So that's one of the disadvantages of equity financing. While the disadvantages of debt financing is its increased risk if debt comes from a variety of financial institutions due to interest charges. If I've got all these different financial institutions giving me money, I'm going to have all these different interest charges, and that comes at a risk because if I can't repay that interest, or if interest rates are going up, I'm a little bit stuck. Regular repayments also need to be made, and security may be required by the business. Equity financing is the internal source of finance in a business. It's cheaper than other sources because there's no interest repayments. Owners who have contributed to the business retain control over their finances. And then it doesn't have to be repaid unless the owner leaves the business. So overall equity is a cheaper option. And as long as it's the owner who's putting in their retaining profits, they can still retain that control. But in saying that, if it's not retained profits, because like we know, equity financing can come from new rights in the and shares, or it can come from retained profits and the owners putting in profits that they've already made from other times back into the business, or their own funds into the business. If it's not coming from that and it's coming from shares, ownership is diluted and current owners have less control. That's a disadvantage. Lower profits and returns for owners as well. And it's a long and expensive process to get the funds from those shares and from those investments. So it's really just a matter of considering which is going to work best for the business. Understanding the advantages and disadvantages is really important because it's a common short answer question. So what are the advantages and disadvantages of debt and equity financing? But also in the business report, I've seen quite a few times that they've written like consider debt or equity financing for this business, and you have to recommend which is going to work better for them. If they're a business that is very focused on having control, and they just need money really quickly, short notice, just to quickly repay it, go to debt financing if there's kind of like a short-term emergency. But if it's more in the long term, they're much more focused on growth, and they'd like to get into the share market, to the ASX, or um they'd like to like grow their business even further and just kind of take it public, then you'd recommend equity. It really just depends on the business. This is a case study for Qantas and how they use debt and equity financing. And the last one we're going to go to before we get to the ratios is matching the terms and source of finance to business purpose. Again, this is another dot point that a lot of my students just forget about, and I don't even blame them because I'm like, oh, this is a dot point. But this again very much links to influences, and that's why I think that the finance syllabus is very interlinked. So what it's saying is if businesses use short-term finance to fund long-term assets, then it causes financial problems for the business. So when you look at the syllabus, there's short-term debt, and that's where it's looking at overdraft and debentures, and then there's long-term debt where it's got mortgages and then the other forms of long-term debt. You want to make sure that when you've got a short-term asset, you're paying that off with short-term assets are paid off with short-term debt or short-term finance. Long-term assets are paid off with long-term debt. So why would you pay it, like if like for a house, for example, in mortgages, or for like a warehouse, you wouldn't use an overdraft for that because that's a short-term finance for a long-term asset. Same with buying like a massive machine. Why would you just overdraft your account on that? Like what is that going to achieve you in comparison to getting a long-term form of finance on that. Sorry, I thought I did that. I mean debenture for long term. So for short term, I've just got the syllabus up. For short term, overdraft, commercial bill, and factoring. And then for long term, it's mortgage, debenture, unsecured notes, and leasing. So you want to make sure that you're using the right source of finance for the appropriate asset. If it's a short-term asset, so if you just quickly need the money for inventory, for stock, or for those short-term assets, you're going to be using those short-term debt. While if it's a long-term asset and that's machinery, warehousing, and those longer terms that you're going to be paying off over a longer time, you want to make sure you've got long-term finance. So the use of long-term finance to fund short-term assets means that the business is still paying the debt long after the financial situation has been resolved. So for example, if I got like a debenture, let's say I needed some quick stock and like one of the tops that I was selling at my clothing store sold out, and I quickly need like a 10K or like this quick restock of it. Why would I choose a debenture for that, which is going to be paid off over time, when I can just quickly overdraft my account or get a commercial bill on that? And then by the time that stock runs out, I've already paid off that debt because they're both short term, rather than still paying off this massive debenture after that whole situation, after all that stock's been sold. Like, that doesn't really match up. So you just have to make sure that financial managers match the term of the loan with the economic lifetime of the asset. If it's a non-current asset, it's a long-term um it's a long-term financing, long-term borrowing, long-term debt. If it's a current asset, you want short-term borrowing. So it's just matching up those two. I'm sorry that I got debenture confused. There's so many different ones you can use. Let's get on to ratios. We've got some time left to finish up with ratios and strategies. A lot of the processes, I just want you guys to know, I'm going to link processes to strategies only because there's certain strategies that you use for certain ratios, so they very much interlink. So liquidity is the extent to which a business can meet its financial obligations. So for that, we're using the current ratio, which is assets divided by current liabilities. The acceptable ratio is 2 to 1. I recommend knowing the objective for each ratio, because each ratio is to achieve a certain objective, and that's how you can link the dot points. Know the objective, know the acceptable ratio as well, and then know which strategy to apply. Otherwise, they're going to give you the formula. It's really only profitability that you guys have to memorize some extra stuff. The current ratio measures a business's ability to pay back their current liabilities with current assets. So the higher the current ratio is, the more capable the business is in meeting short-term financial obligations. But if the ratio is too high, then the business can be criticized for using assets inefficiently. If you've got heaps of cash just lying around, you're at risk to theft and fraud. If you've got all this inventory just sitting there, not only are you paying all this warehousing fees, but all that inventory is dead weight money, because it's money sitting there that could be translated into cash, but it's not, because it's sitting there, and instead it's becoming a cost. So having too many assets isn't always a good thing, and you're actually using them inefficiently if the ratio is too high. While if the ratio is too low, the business is at risk of not meeting their financial obligations, which then puts them at risk at bankruptcy, and becoming insolvent and not being able to meet their debt. So we're not live, laugh, loving either of those. The gearing ratio determines the business solvency. So solvency, like we said, it's how they can meet their long-term financial obligations, and creditors specifically look at the gearing ratio to decide if they should invest or not. And that just shows them whether or not they're going to receive a good return on their investment. So that's where you do the total liabilities divided by total equity to find the gearing ratio, and that really shows and reflects the objective of solvency. For small businesses, the acceptable ratio is 0.5 to 1, while for large businesses, it's 1 to 1. And if the business is more highly geared, it carries a higher risk, but then there's a possibility to generate higher profits because of that risk. So it all depends. If the ratio is greater than 1, it indicates the business has more debt than equity. And if the ratio is between 0 and 1, it indicates the business has more equity than debt. So the higher the ratio, the less solvent the business is, because obviously it has more debt than it does equity, and the higher the risk of not meeting the financial obligation. So that's why the acceptable for large is 1 to 1 and the small 0.5 to 1, because it's making sure there's not too much debt and they're not over relying on that external finance. For profitability, there's 3 different ratios that you can use. That's just profitability is how they're maximizing the profits. And it depends on the revenue earned and their ability to increase their selling prices so that they can cover their costs and expenses. We've got the gross profit ratio, the net profit ratio, and the return on equity ratio. Now, I've already seen that a lot of the time everyone's like, oh, but they give you all the ratios. They do. They'll say, find out the gross profit ratio, bracket gross profit divided by total sales, but they won't tell you how to figure out gross profit. They won't tell you how to figure out net profit. And for gross profit, you need COGS. So you guys need the COGS formula, the gross profit formula, and the net profit formula. You can just quickly Google that, or you can go back to your year 11 notes, because you guys would have done that in year 11, but please make sure you're putting that in your notes, because I don't want you to get caught up on these two and just believe like, oh, they're going to give it to me. They won't tell you how to figure that out. And not all financial sheets are going to tell you what the gross profit and net profit is. A lot of the time, that's the extra step that they expect you to have taken, because you already know. So for the acceptable ratio for gross profit, it's 50%. For net profit, it's 13 to 20%, but of course they prefer to have a high net profit ratio. And for return on equity, they just prefer to have a high return. The gross profit ratio represents the amount of sales that are available to meet expenses resulting in net profit, and then that is used for the net profit ratio. And then the return on equity shows how effective the funds contributed by the businesses are. So it's showing them the return that they're getting on the money that they've put in from their investment. Efficiency is the ability of a business to minimize its costs and manage its assets so that maximum profit is achieved with the lowest possible level of assets. And the more efficient the business is, the greater the profits and financial stable it is. This is where you use the expense ratio, which again they'll give you, and the accounts receivables ratio. Let me just tell you again, this is one of those secrets where a lot of, even like in my class, everyone was like, oh, I remember like I was studying and I was memorizing something like the net profit, and I memorized this formula as well. And some people in my class were like, oh, why are you doing that? They're going to just give it on the day. They'll give you sales divided by accounts receivables, but they won't tell you and they won't remind you that about the 365, where you have to divide it by 365 to find out how many times a year it's being collected. So that answer that you get here isn't right. It's actually how many days that the accounts receivables collected. So you guys need that one. Those are, I think, the main two ways that they can trick you with ratios. And it's really just tricking you because a lot of people think they're going to tell me I don't need to study this, but then they leave out this information. So you do need to know that extra step that after you do sales divided by accounts receivables, you have to divide that by 365 to find out how many days it takes to collect the accounts receivables. And for gross profit ratio, net profit ratio, you need to know how to find out gross profit, which you need the COGS ratio, the COGS formula, the GP formula, and the net profit formula. You guys need those three. Financial managers use the expense ratio to determine where the highest expenses are from and why the ratio has increased or decreased. A decline in the expense ratio indicates there's lower interest rates in the economy or that the business is using less debt, which we don't necessarily want to focus on. Then the account receivable turnover ratio measures the effectiveness of a business's credit policy and how efficiently it's collecting its debt. So a high turnover ratio indicates that the business has an efficient debt collection system. An ideal ratio is 12 times per year or every 30 days or less. If it's more than 30 days, it's not showing that they're very efficient in their turnover collection, which isn't good because their turnover, that's money that they've made that they're just waiting to collect. So if you're waiting 60 days to get your money, first of all, it's not good for your cash flow, but it's also just not good for your asset management either, because that's money that you should have and that should be owed, that you should have in your account that's not there because you're waiting. So having 30 days or less means that you're ideally being paid 12 times a year, and that really helps you throughout every single month of your cash flow, because you've got that money coming in to help out. Now, the last point I want to look at for this is the comparative ratio analysis. I, again, used to forget about this, but it's actually a learn too. So assess business performance using comparative ratio analysis. It doesn't sound as hard as, like, it's very wordy, but all this is, and if you guys have already done finance, you'll know that a lot of the time in finance, you find out your ratio and the ratio that they give you, but then you'll compare that to industry average, you'll compare it to the acceptable ratio, you'll compare it to your competitors' average or competitors' last year's numbers. Comparative ratio analysis is where you confirm against other figures, similar businesses, and industry standards. And by doing that, they can identify trends in financial data, they can take corrective action, and then they can make improvements where needed. You might look at your business from a very like through one lens and think, oh, you know what, our ratios are great, our profitability is great. But then as soon as you compare it to another business, and as soon as you see how other businesses in the industry are performing, you're like, you know what, we actually have to do so much better. Why are they doing so much better than us? What are they doing that we're not? Where can we improve? How can we correct this? And through that they can achieve their financial objectives more. So this dot point isn't necessarily anything you have to study. It's more just making sure that you know the acceptable ratios for each of them, and then just being able to identify that by comparing them and by setting those benchmarks, and through that comparative analysis they can notice those trends and then make improvements naturally. Now, I considered this sacred and I wanted to put these in so you guys have them. I studied off of these when I was in year 12 as well, but at ATAR Notes for all our business students, we really recommend it too. They're basically just summary tables of everything you need to know about the ratios. They've got the objective, so which ratio is connected to which. So like we saw, current ratio was connected to liquidity. So they've got all the objectives in there. They've got the source that it comes from, so whether it's from the balance sheet, the cash flow, or the income statement. They've got the explanation, they've got the acceptable, but most importantly, it's got the strategy. Now, hear me out. For current ratio, for example, and current ratio is how much a business is able to pay in the pay debt in the short term and meet short term financial obligations, so how liquid they are. Let's say from the strategies I picked profitability, those profitability strategies aren't necessarily going to help me because I'm dealing with current assets and current liability, but cash flow strategies and working capital strategies, which is specifically dealing with current assets and current liabilities, which are the two in question, but also cash flow, which is helping me manage that cash to pay off those current liabilities and balance those assets, are going to help me. So this is what I mean where in business studies, and it's with the other topics as well and with the other functions, I know there's heaps of different strategies and a lot of people are like, you know what, I'm going to learn all of them and I can use any strategy for any question. It's not always the case, and especially in finance, there are strategies that are better suited to certain ratios. So that's why I wanted to give you guys this sheet so you guys can see, and I've got them for all the different ones. So even if you don't want to download the slides, I recommend just having a copy of this. This is all I studied for ratios, and it really helped me with my marks, but also just with my assessments and my understanding, so I could just connect which was working with which. For current ratio, for example, if you do discounts on early payments, distribution of payment, and factoring, they're all coming from cash flow management. And then we've got control of current assets and control of current liabilities, which are working capital management. So they're specifically going to help with those. For profitability, the two main strategies I recommend, guys, is expense minimization or revenue controls. Revenue controls is literally just increasing your sales through marketing and maximizing your revenue with a better mix of marketing. So with profitability, the only two ways you can really affect it is increasing your sales or decreasing your costs and expenses. To decrease your costs and expenses, you want to turn to expense minimization, which is one of the profitability management strategies. For expense minimization, there's all different things you can do. You can start buying in bulk, bundle pricing, you can outsource, you can do a casualization of the workforce because casuals don't have to be paid annual leave and sick leave, so they're actually cheaper as a whole in terms of labor. You can find cheaper suppliers, you can downsize or relocate operations. There's all different things that you can do to minimize your expenses, and by minimizing your expenses, you're going to end up maximizing your profits. But on top of that, if you are struggling to cut down on your expenses, you can actually just increase your sales and look at your marketing mix and use your marketing more efficiently. So looking at the pricing policy, making sure you're not overpricing, making sure you're reaching your target market, adequate sale forecast, and just again, you can really, if you don't feel too confident on finance and you get a question on profitability strategies, best believe you bring in all your marketing knowledge, and I was a marketing lover. You can bring all of that in and literally just talk about marketing strategies because it's the 4 Ps, which are the 4 Ps from the marketing strategy syllabus. So you can just pull that in. That's a little hack of business studies. Same for efficiency and the expense ratio. You want to make sure that, well, it's expenses, so utilize expense minimization as a strategy, and that's why certain strategies are going to fit ones better. But for accounts receivables, it doesn't really make too much sense to do expense ratio, but it does make sense to do discounts for early payment or to turn to factoring, which are directly associated with accounts receivables, and discounts for early payments of your accounts receivables, or selling your accounts receivables to a factoring company and getting 70 to 90% of that money back. Use the right strategies for the right objective. And then solvency, which is total liabilities versus owner's equity. You can lower your debt through expense minimization. You can do working capital management strategies. You can leasing, factoring. There's different strategies that you can use for each, but that's why I really recommend just having a copy of these, because I think that being able to connect your processes with your strategies is a really big game changer, and you'll find that comes up a lot in the exam. Let's quick